Hello everyone, my name is Kerenyi. I'm the coordinator of the Financial Stability Working Group and I'm the host for this session. First of all, let me just introduce our mentor for this session. He is Kimmo Soramaki, who is the founder and CEO of Financial Network Analytics, very well known as FNA. But he is also is a founding editor-in-chief of the Journal of Network Theory in Finance. Kimmo started his career at the National Bank of Finland. Our first speaker is going to be Naomi. Naomi Alvarez is she's from the Federal Reserve Bank of Chicago, where she has developed deep expertise across a number of financial policy areas, such as market infrastructure, derivatives markets, money markets, fintechs, financial technology companies, climate risk, ESG investing, and other issues relating to the financial stability. She is currently pursuing an MBA at the University of Chicago Booth School of Business. Naomi has a program, and that is why I'm going to leave the floor to you, Naomi. I'm really thrilled and delighted to have you here in this panel, and I'm looking forward to hear your presentation.
Thank you, Adam. Can you all hear me okay? Great, no echoes. So I want to thank you for setting this up. I think it's always a good idea to create more questions for research. So give me 1 second. I'm going to take my headphones off. There we go. I much prefer that, I think. So, So my name is Naomi Alvarez. As he mentioned, Adam mentioned, I'm from the Federal Reserve Bank of Chicago, and I work in a group called the Financial Markets Group. The work that I'll be presenting today is a joint collaboration with a few of my colleagues, one of which fortunately was able to join today, Ketan Patel. And we've been thinking about climate change risk, in part because there's a growing recognition. We think that the climate change risk poses a new challenge for economies and for financial markets. And secondly, because we have deep expertise in financial market infrastructure. And so we're always thinking about ways that things could go wrong and how to think about those potential crises and how to avoid them so that we can ensure smooth, efficient markets. And so that's sort of the perspective that we're coming in with. There has been a ton of work done in this space. So we thought there were a lot of big questions and a lot of big issues that remain to be resolved. So the way we approach it is through a case study. So today, let me share my screen. I will be presenting just one sort of mini project that we've looked at on how we should think about this. So share screen. Perfect. Play from start. Okay. So please let me know if you have any issues seeing this. But I don't know if I mentioned this, but please note that the views that I express here today are only mine and not those of the Federal Reserve Bank of Chicago or the Board of Governors. All right. So as I mentioned, there were some big questions that we had coming from the perspective of researchers who think about risk management regularly. And so traditionally we think of things like market risk and credit risk and liquidity risk and operational risk. And so those are sort of like the orange things in this graphic. And in the last few years, we noticed that there was this new framework that had come out to think about climate change risk. And they thought about it very differently. And so these are folks at the Bank of England and Financial Stability Board and different international bodies as well as domestic bodies that were looking at climate change risk from the perspective of physical risk. So that's the risk that physical climate events could pose to the economy. They were thinking about transition risk as well. So the different risks that could come up as folks transition to a green economy and other things. And then there is this liability risk. What happens when you don't adapt and mitigate? And so, we're trying to think about how to bring all of this together in the context of the market structure that we have set up today, and then all the regulatory frameworks that are in place. And so, again, a very big topic that we thought we would approach with a case study on how we might think of climate change risk impacting financial market infrastructure. And so, some of you might remember this from 2018, but in 2018, there was a trader in Norway that defaulted at NASDAQ, and they, in the central clearing and derivatives community, there was a lot of discussion about what happened and how the CCP handled it. And we know, sort of, for those of you who are not familiar with the events, we know that Einar Oz, the Norwegian trader, had taken a financial position that prices in Nordic and German electricity markets would converge. And instead, we know that prices diverged. And so this position ended up costing him a lot. And so NASDAQ issued an intraday margin call on Monday, September 10th, which was almost exactly 10 years after the Lehman Brothers default threw us into the global financial crisis. So sort of I remember waking up and thinking, wow. So that happened. And we know, in sort of looking back at how those markets were operating, we know that the price movement that we saw that day was far outside historical norms. And so this chart here shows the red line is 2 standard deviations away from the average price. And if we look back to 2014, we knew that the spread hadn't widened that much. And NASDAQ conducted their own analysis, of course, in the days after that, where they say, I wonder if you guys can see this, if I have this here. In the days after, where they said, NASDAQ data analysis concluded that the market movement was 17 times larger than the normal observed daily spread changes, which was confirmed by 2 external parties and could be characterized as a true black swan event. And so there was this discussion about, if it's a black swan event, can risk management processes even account for that? They're not designed to cover black swan events. So should we think about this as a sort of one-off thing, or should we be thinking about what that means for risk management? And so, lots of good conversations came out of that. And let's see if I can click on this. There we go. And, so NASDAQ issued the intraday call on September 11th. We know that Oz was unable to meet the intraday call. NASDAQ clearing declares it a default on Wednesday, the following day, and really through the end of the week. It's no longer Oz that's sort of in the hot seat. It's the rest of the clearinghouse and the clearing members. Everyone's getting together and trying to figure out what to do with this portfolio, how to close it down, how to stem losses. And in the end, we know that it ended up being a costly default for everyone. And we can talk through what that looks like. Thinking back to how did this happen, there's some folks out there who will say that it was a risk management thing, it could have been avoided. But at its core, we thought that something that was missing from the conversation was the events that led up to it. So we know that on one hand, the prices converged because in Nordic markets, there had been a bout of extreme heat and then rain right away, and that contributed to hydropower prices moving in unexpected ways. And then at the same time, almost by coincidence, in Germany, there is a change in climate policy. And so suddenly we have this sort of like climate related thing in Germany, and then this thing happening in Norway, coming together to create the perfect storm, if you will. And so it's, at its core, it's an example of climate change risk. And we like to think in derivatives markets, especially that where we hedge things in the short term, that's something that we don't really have to think about, right? Like climate change risk is this long-term thing that someone else will deal with. And here you have an example of it happening suddenly in the short term. And sort of painting a perfect picture of what could happen if risk management processes don't consider these type of things moving forward. And so to talk about really like what was the impact and why was this such a big deal, we can look at the NASDAQ Nordic waterfall, and we can look at what resources were in place for defaults generally. And we know that in this case, if you look at the orange column, the clearinghouse went through all of Einar Oz's initial margin that they had posted at the CCP. They also went through Einar Oz's contribution to the default fund. They also went through NASDAQ's junior capital that they had set up, and they hit the default fund for commodities. So those of you who know something about CCPs will know that this is sort of a big deal, right? This doesn't happen often. This is the mutualized fund that every clearing member pitches in for, and that then has to be replenished when that's covered. And so all in all, we know that there were over 114 million euro that went to this default of this one trader. And so it's sort of, it's not just one trader loses a lot. It's like everyone sort of is feeling the pain of this risk not being factored in. And so this is sort of what I was referring to on why do we care? Historically, there have only been a couple of times that this has happened. And we can, there also, if you're interested in this, like there are a couple of my colleagues and and other folks have written case studies on the few times that this has happened. This is how rare it is, right? And sort of some lessons there. And by comparison, and granted, this is an imperfect comparison because the portfolio that Lehman carried was very different from this, but when Lehman defaulted in 2008, neither the CCP nor its clearing members actually sustained any losses. So, back to this chart that we had here, they didn't hit that default fund that was mutualized. And that was a portfolio with, $9 trillion worth of notional value. So a much bigger position. And so there were all these questions naturally that came out of the NASDAQ default about what happened and how this, this could happen. And so just to recap, I think this point about in derivatives markets and in the world of financial market infrastructures, there is still a lot of room to think about climate change risk and how it can impact different markets. And so you can think of energy markets in like in this case, but you have all sorts of markets that could be impacted. And we know from the COVID pandemic that there are all sorts of markets that might not be directly related, right, to maybe the health sector that will face sort of some serious changes when these crises arise. And so our take from this work was that there's more research that needs to be done. This is just one case study looking at it, and we should have a forward look, because traditional backward looking risk assessments and models, such as the one that NASDAQ was using, looking back at sort of like the price movements historically, may not be enough to manage and mitigate the risks of the future, especially if we think of a world in which future weather and future policy related to climate change will be much different from what we know today. And some, we think integrating climate change risk into the financial monitoring that we do and the risk assessments that we do will require concerted effort from all sorts of players. And so we're thinking about having these discussions with folks here who are committed to doing more research, but we think it's a broad spectrum, and we hope that this conversation will carry on. So that's the work that we've been doing in the Chicago Fed. Again, my colleague Ketan Patel, sorry to put you in the hot seat. I did the easy part and then just threw him in the deep end, but he will be here to answer any questions, and I will turn on my video, but I will be on as well. Thank you all.
Yes, thank you, Naomi, and also thank you for keeping the time limit. And now the session is going to be followed by Kimo's comments. Kimo is our mentor, and let me just share with you some background about Kimo. That during the financial crisis, Kimo advised not only Bank of England, but other several central banks, including the Bank of England and the European Central Bank. He was focusing on modeling interconnections and systemic risk. And this work of his led to him to found FNA, which I already mentioned to you, Financial Network Analytics, which has just won a great prize, G20 Tech Sprint prize. So congratulations, Kimo. And we are looking forward to hear your comments regarding Naomi's presentation. And then after, if any from the panel is going to have questions, Naomi is unfortunately going to leave soon, but please leave the question in the chat, and I'm going to forward the question to her and to her colleague. Thank you. Kimo, the floor is yours.
Thank you. Can I actually share one thing on the screen? If you can stop sharing, I can.
Yep.
One thing. So actually, first of all, I think that was super interesting. Actually, I didn't understand that there was a climate change angle to the Einer Aas story. So that was news to me. Mm-hmm. We were in discussion about climate change a little bit everywhere. It's just such a large topic and affects everything. I think, but that's also the challenge with it, that it's everything about everything. It's about supply chains. It's about the extreme events that then feed into the clearing, the prices, the markets, everywhere. So I think it's relatively difficult. And then the fact is that you don't know what is going to happen. And I'm going to show one picture here. This is actually something I took myself in Bucharest. It's a bunch of black swans. They're much more common than you would think. Actually, they're everywhere. They're going in every direction here. There are so many black swan events happening all the time, but in a particular category of events, they are very rare. but across categories, actually, they become very common because like there's always something, once in 1,000-year event is happening somewhere all the time, every day. I think that's sort of, I think, like one of the lessons also from the presentation is that that this you know, like you don't know what is going to happen, and very rare events will happen very frequently because there are so many types of events that can happen. I actually, after this, I Googled it, like, and this is actually a type of swans. It's the black swans. There, I think they're in Australia more frequent. But that was after this, we went rowing on that little lake, and a huge storm came, and it pushed all the boats like on the other side. There was this like guards coming up to rescue people from this. It was a little lake. That was another black swan event that happened on the same day.
That's very ominous.
Yes. All right. So I think there was the other one, the Ronin capital. I think this year as well. That was, I think, more related to the COVID-related volatility. As another example of the same. But as you said, there aren't so many of these that happen. I think like what we're trying to do there is to do the, in a way, the analytics in advance, so that you can quickly start to understand what is going on. Because in these situations, when something happens, I remember when I was working at the central bank, you know, the board member comes to me and says, like, Kimmo, what is going on? and then I don't know. I need to scramble data together in order to start explaining it. But we are at FNA, and that was the reason I set up the company in the first place, was that hey, can we pre-do this analysis, have these networks and interdependencies mapped, so that when something happens, we'll go in and look at it rather than start the analysis from scratch. Anyhow, very good. Thank you.
Thank you, Kimmo, for your very important comments. Is anyone has a question to pose to Naomi? Because it is the last chance that he or she can make it before she leaves. Okay, I have one question, and please. So what is your topic? It is a personal question. What are you studying at MBA at the University of Chicago, Naomi? I'm just curious about it. So you have so many expertise in the field, but are you going to? So I'm looking forward to your reply.
Thank you so much again. I think, you know, the University of Chicago is known for its finance and econ curriculum. So very excited to do that, taking a future swaps and options class, which is just up our alley. So yeah, that's sort of it. Wow.
And thank you again for
thank you.
So we could start with you, and safe travel to you. And the next presenter is going to be Bazil. Bazil is from University of Warwick, and now he lives in Bristol, where a Hungarian football player also plays at that club, if I know well. Bazil also was present in a session with us a couple of days ago. So I hope that every recordings will be available. And if you are interested about LPFMI, that is a must that you need to watch. That was such a nice session. And so I also did some research about Bazil, and I found that he is not only a research economist, but a policy professional and a data geek. Currently, he is a research fellow, University of Warwick, as I already mentioned, that he is an applied economist with research interests primarily in macroeconomics, housing markets, and topics in macrofinance. So, Bazil, we are so glad to have you here, and the floor is yours.
Thank you very much, Adam. So, can everybody see my presentation and hear me?
Yes, and we also see your comments on the slide also. Do you want us to see them?
Right. No. I don't know how to change that. Everybody could see that, could they?
Yes, we can see it.
Even the bottom left, the other view.
how does that change it?
That changed everything. Thank you, Kimo, for your nice mentorship.
Is that working?
Yes, it is
Yes,
working.
that's perfect.
Great. Okay, so thanks for the invitation to share some work and research directions we're developing today. So today I'm going to share with you some work we've been doing around something called trophic analysis and its links to dynamics in complex systems, and also some directions we're starting or beginning to develop, linking these ideas to LPFMI relevant themes. So what is trophic coherence? Trophic coherence is a measure of the extent to which it's possible to assign levels to the nodes in a network such that levels increase by a sort of +1 along each edge. So this slide is presenting an example of a simple example of a perfectly coherent network. Here you can see that every node of the network can be assigned to one of 4 integer levels. Of course, not all networks look like this. In fact, most real-world networks don't. Specifically, sort of feed-forward structure in a network, and in particular, cycles or feedback structure reduce the coherence of a network, or your ability to assign these sorts of levels. And so so I should say that most or all of what I present today is the work with various collaborators who I will introduce to you later in the presentation. But so we've been working on methods for sort of quantifying these structural features of networks, and so it turns out that in the real world some reflecting so cycles reduce the coherence of a network. They make them more incoherent. So one way of thinking about trophic incoherence, or one way of thinking about trophic coherence would be as a measure of the directionality, overall directionality in a network. And so some networks are more directed than others. So on the left here have a corporate ownership network, which unsurprisingly is a very directed hierarchical. So we have these many hierarchical levels. And on the right, this is an input-output network. So aggregate sector level flows of goods and services between sectors, and the circular flow coming from sectors acting as buyers, suppliers, and buyers to each other means it's quite incoherent. What does this have to do with systemic risk? Well, one answer to this is that so cycles can destabilize dynamical systems by introducing feedback. And so one answer would be that more coherent networks may be more stable due to lower feedback in the system. For example, we find a correlation between the incoherence of a network between network incoherence and its leading eigenvalue. Leading eigenvalue, of course, has been shown to control the dynamics or control stability of a whole range of different dynamical processes on networks, from simple container dynamics to default cascades, state rank dynamics, synchronization dynamics in networks of coupled oscillators, and so on. So in one initial simple exercise to explore or link trophic structure to dynamics in financial network context, we use a sort of simulation exercise, stylized representation of a banking system with interbank lending and borrowing, and use debt rank in order to quantify systemic risk in these systems. So debt ranks are the widely used benchmark algorithm for stress propagation in lending networks, where a shock to assets reduces banks' equity and potentially leading to pushing it closer to default, potentially generating a cascade of asset revaluations within interbank lending network. So a simple exercise, we simulate these sort of systems, systematically varying trophic incoherence of the exposure network and balance sheet leverage. And then in order to assess the systemic risk in these systems, we simulate the uniform shock, run debt rank algorithm, and obtain total relative equity loss, either the fraction of equity lost in the system once debt rank dynamics converge. And so we find that more incoherent networks, that shock amplification is network-based shock amplification is larger in more incoherent networks, even where buffers are conservative. So the takeaway message is, well, buffers may not necessarily be enough depending on network topology, but also, and perhaps most interestingly, implies systemic risk could be reduced by rewiring the network to achieve a more coherent structure. And so this is sort of feasible without the need to change individual funding or lending positions. And then this raises the question whether some sort of incentive could be provided to incentivize the endogenous formation of more coherent networks. So, for example, some sort of regulatory capital requirement or transaction tax that's proportional to the level differences between trading nodes, which would break coherence of the network. What's I don't have a clock here, but so what's any of this got to do with derivatives, clearing, or the LPFMI themes? Well, so one widely made argument for the introduction or the benefits of moving to central clearing is that central clearing can simplify the complex and opaque web of exposures between counterparties. And so this slide shows the perhaps by now famous chart from a paper by then chairman of the Federal Reserve, Janet Yellen, showing the hypothetical sort of impact of moving to central clearing for a market here. But so this star structure that we see on the right, really this relies on so this is the case where we have 100% central clearing of the market and is sort of cleared by a single clearinghouse. Things get more complicated if there's differentiation of asset classes and or if the market isn't 100% centrally cleared. So there's a combination of bilateral and centrally cleared. And of course, in reality, we live down in the bottom right here, where with a combination of both. So here's just some empirical. So these are sort of hypothetical. Here's some empirical networks. One from chemo to FNA, and one from the Bazil. So these are networks that are connected by a network of clearing members and clearing houses, connected by clearing members clearing with multiple CCPs. And then here's another empirical network. So this is UK over-the-counter derivatives market data, and you can just about see CCPs here highlighted bright colors. So there's still lots of complexity and connectedness here. And then so another another sort of very intensively made sort of argument for rationale for central clearing are the potential benefits from multilateral netting opportunities. So here in this sort of stylized toy example, the move to introduction of a central clearing house reduces the total gross notional. So it's also clear here that this could be halved again by removing the CCP, in fact. But one thing to sort of notice here is that the sort of redundancy that generates opportunity for multilateral gains from multilateral netting here comes from the sort of cyclic character of this toy example on the left. So maybe there's a link here between okay, and so you notice that so this is perfectly incoherent. Well, no, not perfectly incoherent, but it's incoherent because of this cyclic structure. And then here we move to more coherent structures. So there's some link between a more coherent network structure and reduced redundancy, and this was of reducing credit risk, regulatory capital that's based on growth rather than net positions, collateral requirements, and this demand for liquid assets, etc. But so one direction might be to clarify the link between trophic coherence and redundant trades. Could this be used to incentivize the endogenous formation of networks with sort of lower redundant exposures, or relevant for sort of post-trade questions of post-trade compression? But so just looking at exposure, not enough. So I think a sort of rough roadmap for us is something like starting from, what's a good model for quantifying systemic risk in a clearing network, and so this would be exploring lots of themes of sort of central interest to LPFMI project, and then sort of using that to explore role of topology for the systemic risk in these networks, with especially, or anyway, starting from trophic analysis, trophic structure, and then finally considering how the understanding of this can be exploited in order to find ways of removing risk. And so finally, if I have time, just to say that so the work, so what I'm sort of presenting here, a lot of it's work with Robert and Sam, and then the sort of questions around clearing networks is something that PhD students of Robert and myself, Yijie Zhou at the bottom left here, is beginning to develop, and I hope that you'll have the opportunity to hear him share work as it develops in future. And then this is also, we're developing this sort of in collaboration together with Ivana at FNA, and with some exchange also with Samantha Korkova, sort of wider application of trophic analysis in financial networks, sort of relevance for systemic risk issues. And that's the end of what I was going to share with you today. Don't know where I've got to time-wise because my clock didn't work, but
you are very, thank you, and I'm also very happy that we have EG from your working group together with us, and thanks for keeping the time limit. Kimmo, can you please share your thoughts about this presentation of Bazil's? Thanks.
Sure, very happy to. Also, I would like to share my screen again, like at some point of time. So, first of all, there's a lot of stuff in that the presentation. Like it was going a very quick pace through a lot of, I think, important topics. First of all, I think it's quite amazing that we can use something that has been developed for describing food chains in finance. But then again, we do have also whales who do big trades and bull and bear markets. So maybe there are a lot of animals in finance too. But I think like on a more serious level, but I think when we are doing like calculating these type of metrics for these networks, I think what we're trying to do is to create a language to describe these very complex networks in some way and communicate and simplify them so that we can talk about them. Because the problem with these networks is that they're very complex. It's very hard to understand what is going on. So I think like adding, taking from other disciplines, like ways of them, how they have described these networks, I think is very useful by itself already for finance. And then the second piece is, okay, so then we want to usually relate these metrics that we calculate, you know, like algorithms that describe these networks to some real world events. So that's quite often done through simulation. So it's not really, but at the end we're comparing one algorithm to another algorithm because we don't have that observation from the real world measurements to relate to. Which I think is quite interesting, and I've done it myself as well. I always wondered why do I calculate the other algorithm while I have the other algorithm? Maybe the other algorithm is easier to calculate, so therefore, and is easier to communicate. So the coherence is an easier concept to communicate than running a simulation of failures, for example. Then there was. I'm going to show you actually I'm going to share this out. So we launched something called the G20 Monitor like a couple of weeks ago. It's free for everyone to go. You just need to register. You can see the picture that Bazil showed. Do you see my screen now?
Yeah.
And it's the network picture you see, right?
Yes.
Yeah, so you can see, I'll put this link there. You can go see that. There's also other like dashboards there, for example, on the Einar-Aas contagion. So you see sort of what was the contagion path, like on this. There's also videos that you can look at, and it explains how it works. But which CCP Einar-Aas was connected to, which other members they had, what other CCPs they participated, and so forth. And really is, you know, like the central clearing hasn't simplified the network structure necessarily. What it's done is to create this huge global network of interdependencies that we see when we see this through these common memberships of these large institutions. We mapped this data set, and this data set is also available for research if you like it. 739 nodes consisting of clearing members and then the CCPs that they participate in. And our plan is also to keep this data set updated. I think that the last bits were also interesting around post-trade compression. So there are a couple of like companies doing that, and I think there's more and more interest in that. and to describe that as bringing coherence to the system. I thought that was novel. I hadn't sort of thought about that before. We are also working ourselves on the same problem, but on intraday liquidity, orchestrating the payments, for example, of a large bank. They're making payments from several accounts to several accounts. Like how should those payments be orchestrated? Or the same thing with the national payment system. Instead of using netting, maybe like you could just do them a little bit smarter, in a smarter order. But those problems get very hard, I think, when we try to do brute force, we can do 13 payments at brute force. But like we have many more in the real systems. So.
Right, so existing approaches are pretty computationally intensive, right? Is my impression there.
Yeah, exactly. Yeah. So then, and then it's about. It's also about, because you can combine all these things together, adding new trades, doing netting, doing splitting trades into pieces, and then there's a time dimension for intraday liquidity as it fluctuates over time. So it's maybe not one clearing event at a time only. But if they are done in real time, so there's lots of dimensions to that problem. I think like at the end there's huge savings and huge operational efficiencies to be gained there, especially because banks or this data hasn't been available before. It's only become, they have now started to build their data lakes and have global visibility on the problem and possibilities to optimize it. So I think there's lots of future work that will be very relevant around that post-trade and optimization of liquidity.
Thank you so much. Let me just follow with a lot of future work. So what are your plans, Bazil? When are you going to publish the results, or what is your future research plans about this project? Because it seems to me a very path-breaking pioneer project for me.
Well, so there was sort of quite a lot in that presentation. So some of those results are already published work, right? So methodologies, etc. And then also just the sort of work linking trophic structure to debt dynamics, that stuff, that's out as a working paper, rebuilding macroeconomics working paper. But really moving to so the sort of the new work that we're moving into is okay, focusing on clearing networks as a particular application, getting into so sort of forms of risk that perhaps seem more sort of real world relevant and interesting and prescient, sort of systemic liquidity, and more broadly, looking at exploring the relationship between trophic structure and more complex dynamics, right? Richer models. Yeah, and well, this is what we'll be developing, and I'm sure we'll be producing things at regular intervals along the way. But as I say, so some of this will form a core focus for Yijie, who, I don't know if Yijie doesn't have you don't have your video on Yijie, but who's here with us now. So this will be sort of doctoral project for Yijie over the next few years as well. And it's sort of a growing team as well. So as we sort of add people, things will sort of move. We'll do more and sort of finish more faster, I suppose.
Thank you, Bazil, and I hope if you are looking.
I should also say we really welcome anybody who wants to be sort of in touch with any of this, or is interested to sort of get involved. To be would really welcome that if anybody wants to be in touch.
Thank you. That sounds great. Okay, so is anyone from the participants has a question to Bazil now? Just or maybe you can write in the chat or just raise the hand, or just unmute yourself.
Or email me later.
Email you later. Okay, okay then.
I'm not. That's not a request. It's just.
I know. But maybe they are going to, because there are a couple of young scholars among us, so maybe they are going to just, and many people are going to watch the recording. So thank you for this option, and that could be very, very useful. Maybe you can write your email address to the chat, but you are in the YSD, so the YSI platform, and anybody who is there can contact you by sending a message, finding you in the profile.
Yeah.
Okay.
Also, I shouldn't be hard to find. Just Google me.
Yeah. Okay. Okay. Thanks. So the next speaker, I'm very delighted to have him with us because he is a father of a very young child, Christoph Becker from Germany. He is a professor of financial mathematics at the Darmstadt University of Applied Sciences. He just gave another session in the warm-up week of the YSI plenary. He was talking about, among others, the money view of perimeter links. And he also interested in the stability of the shadow banking system. And he's focusing in particular in the empirical investigation of the liquidity risk. Christoph, the floor is yours. We are looking forward to hear you.
Okay. Yeah, thank you for the introduction. So let me share my screen with you. Okay, now you should see my slides. Good. So the topic is dealer risk and central clearing counterparties. So let me start with a picture. What you see here is the dealer bank, and the dealer bank needs funding liquidity, which you see here, and of course liquid assets to make markets, specifically money markets, but also equity bonds, FX, commodities. And now the CCP enters the picture, and the CCP also needs liquid assets in the form of initial margin requirements, default fund components. And in a sense, both the dealer bank and the CCP are competitors for these liquid assets, and in doubt the CCP wins because the CCP can always tell the dealer bank, I want more liquid assets and I will charge you more initial margin. And now the question that I want to ask is, what does the introduction of such a CCP actually mean for the risk exposure of the dealer bank, which is one of the most important clients of the CCP? And more generally, how are CCPs connected to the rest of the financial system, so the part up here. So my focus is clearly on what is going on with these liquid assets, and that's very different to what the conventional research focus is. So here is a list of research papers, and you see here most people focus on credit risk related issues, multilateral netting, the default waterfall, etc., etc. And that's not what I will have a look at in this presentation. So my working hypothesis is that CCPs transform all kinds of risks they face into liquidity risk for their clients. They shift this liquidity risk in the form of initial margin requirements to their clients, for example, to dealer banks. And my research question is whether I can find a statistical link, an empirically verifiable link between the initial margin requirements of CCPs and the, for example, liquidity risk of dealer banks, or more specifically in market prices, say in the liquidity spreads in money markets. That's my question. So the economic motivation is very simple. Here you have the balance sheet of a dealer bank. Here are the liquid assets, for example, treasuries and reverse repo. And the dotted share here is now pledged in the form of initial margin to the CCP. And that means that the liquidity risk exposure of the dealer bank goes up because the dealer bank sort of loses a part of its liquid assets. And an adapted version of the trainer model that I think many will be aware of will tell us that if the risk exposure of the dealers change, they will adapt bid and ask prices. And the initial margin requirements from CCP members is roughly 3 to 5% of the HQLA of primary dealers. So it's large enough to be important at the margin. Good. The data that I use is the size of the initial margin required by CCPs as measured by the CFTC. So you see in 2014, this was roughly 90 billion US dollars, and now 130 billion at the end of 2019. This doesn't sound to be, it doesn't look like a big number relative to the size of the rest of the financial system. But look, this amount of money is more or less directly taken away from the dealers. This money would like to be liquid assets on the balance sheets of the dealer banks, but they are now transformed into liquid assets for the CCPs. So although the number looks small, it could have a large influence on prices. And I will have a look at this empirically now. So here you see regression results with all kinds of control variables, so the usual suspects, the VIX, TED spread, the time trend, etc., etc. And what you see here is it's a sequence of regressions to explain the spread between the treasury bill and SOFR, secured overnight financing rate. Both rates do not contain solvency risk, so the spread is exclusively about liquidity risk. And you see here that the initial margin component plus the volume of treasury bills out there in the economy explains roughly 45% in the variation of this liquidity spread. So this is already a lot. Here you see a simple measure for the liquidity risk exposure of the dealer bank. It's repos overnight, a liability of the dealer banks, minus reverse repos overnight, an asset of the dealer bank. And you see here that the initial margin component alone explains roughly 50% of the variation of this measure over time of dealer liquidity risk exposure. And it explains roughly 40% in the variation of this capital ratio here, which is market leverage of the dealer banks. Good. This all looks very nice, but the problem is it is only a statistical correlation that I measure here. So what is cause and effect? So the correlation between the initial margin and liquidity risk could be just a spurious correlation, but I don't think so, because initial margins relative to HQLA of dealer banks is sufficiently large. Then one possibility could be that liquidity risk drives the initial margin component. So that would mean that CCPs observe a change in liquidity risk and therefore they charge more initial margin just as a kind of private safety measure, and that's it. Or it could be just the other way around, that the initial margin component drives liquidity risk. And that would be not so good. That would mean that CCPs causally reinforce business cycle volatility. And we'll have a look at this in a second. To distinguish all these cases, we need instrumental variables that are, on the one hand, correlated with changes in the size of the initial margin. Yeah, that's point one. But these variables must be uncorrelated with any kinds of changes in solvency, liquidity risks in the rest of the financial system. And that's not so easy to get hold of. What I use are dummy variables for phase-in dates of the global uncleared margin rules. They're clearly independent of the any kind of financial risks, because the dates are set in a political process. That's it. And the idea is that swap dealers now must also pledge initial margin if no CCP is involved. And that began in September 2016 and covered more and more investors. And in the last phase, it covers investors with an aggregate notional amount of only $8 billion US. Good. And these phase-in dates mean that there's an influence on the size of margin requirements in the financial system, independent of financial risks. That's the idea. Now here are the results. You see various liquidity spreads in the money markets, SOFR versus Treasury bill, TGCR versus Treasury bill, financial commercial paper versus treasury bill, etc., etc. And here's some spreads in bond markets. Here you see the size of the initial margin required by CCPs, and the T statistics is most of the time larger than 2 in absolute value. So it's always statistically significant, which is nice. And now this is a causal effect. That's the important thing. But what you see here is that a 2 standard deviation shift, so the variable is standardized, a 2 standard deviation shift in the size of initial margin increases, say, the SOFR versus treasury bill spread by 0.12%. So it's statistically significant, but it's a statistically significant mouse, a very small effect. But wait a second. Here is the causal influence of initial margin, for example, on the liquidity risk exposure of dealer banks. And here it's also statistically significant, but a 2 standard deviation shift increases the dealer liquidity risk exposure by 28%. And this is a lot. This is a lot. And it has an influence on, also a substantial influence on market leverage of dealer banks. Now, just to illustrate the main effect that I find important, which is this number here, or these 2 numbers here, on the x-axis you see the initial margin as required by CCPs. On the y-axis you see this measure for dealer liquidity risk exposure, and it goes up. And if you move 2 standard deviations to the right, you increase from 6.3 to 6.5 roughly, yeah, on log level, and that's the increase in roughly 20%. Okay, what I present here is preliminary research. So I'm still wondering what the meaning is of all the empirical findings that I've shown you here. The statistical results all tell me, yeah, everything is fine, but there's an issue. Because the uncleared margin rules actually do not increase the size of the CCP's initial margin requirements, because I actually expected that there is a shift to central clearing, but it's not. What you see here is data from the BIS that in 2016, at the beginning of the introduction of the uncleared margin rules, there were 75.8% cleared products in interest rate derivatives, and now it's 2 years later, it's roughly the same, and the same for FX, etc. So this is a problem. I still look, and that's what I'll do in the next few weeks, I still look for a good instrumental variable to show the causality of the initial margin on dealer liquidity risk exposure. But you can still find a reasonable interpretation for what I've done so far. Basically, what I've done is I used time dummy variables for the phase-in dates of the uncleared margin rules. And in the instrumental variable regression, I projected them onto the margin requirements by CCPs, onto the data that is actually collected by the CFTC. And then I can show that the projected version of these time dummy variables actually causally influence dealer liquidity risk and liquidity risk premia in the money markets. So that's a result that's already safe. Good, let me conclude. What I do here is I investigate the relation between CCPs and the rest of the financial system. And the picture that emerges to me, it only begins to emerge, is that the CCPs tap the liquid assets of dealer banks in the form of initial margin requirements. And that makes life more difficult for poor dealers. Yeah? I found a causal influence by the uncleared margin rules on liquidity risk for dealer banks and in money markets, but the causality of CCP's IM requirements themselves is still an open question. So here's a little picture. Here is our dealer bank. It needs funding, liquidity, and liquid assets to make markets. Here is the CCP, and it taps the liquid assets of the dealer bank. And therefore, we see a correlation, no causality so far, a correlation between the initial margin requirements and spreads in the money markets and liquidity and solvency of the dealer bank. And in the case of a very specific kind of initial margin, namely those required by the uncleared margin rules, we can even see a causal effect, a small one to money markets and a very large one on the liquidity risk and solvency risk of dealer banks. That's my result so far, and thank you for your attention.
Thank you so much, Christoph. It was a really nice presentation. And Kimmo, do you have anything to add as a mentor?
Well, maybe I'll discuss a few things. I think it was super interesting. Thanks a lot. It also took a little while to digest, seeing it for the first time. But there are a couple of items. So the intuition is that the initial margins suck out of liquidity from the market, and that then has a price impact because that liquidity is not there. This reminded me of something similar that was with the Bank of England when it had rules for maintenance periods of the monetary policy maintenance periods. So they always saw spikes of costs for overnight lending when the market participants were trying to game each other and put each other in the corners and then charge higher interest rates towards the end of the day, so that they would be able to then have the money to put on the reserve requirement. So it was you had to sort of certain reserve requirement dates. So that's in a similar, like you have to have a certain amount of money, and then that had a price impact because the participants were charging more for those who hadn't gotten their loans earlier in the day. So it was later in the day they charged them. So I think the similar sort of sucking liquidity effect that has an impact on prices. And then I was thinking the other one was with CLS. So CLS is the system for settling FX trades. So you had very low numbers for the CCP settlement in the FX column.
Yep.
But you have CLS pay-in requirements, and those are probably public as well. So you see how much it's the same initial margin, but it's like a netting effect. Like you have to put in the money, your net amounts over the course of the morning. So it also sucks out liquidity. So maybe you can do similar type of analysis on that on the FX markets. It's not strictly CCP, CLS, but I think like from an analytical perspective, it operates exactly the same way.
Yeah, that's interesting. Can you send me a link or type it into the chat so I can find it?
Yeah, I can. I think we've published something on the CLS, so I can maybe
cool.
think about the rest of the course. But it's the same effect. CLS asks all the member banks to pay in money to them, and those can be like when I was at the ECB, so we did a lot of analysis when CLS went live 2003. Like, are these pay-in requirements too large for the banks to handle? Like there could be like 18 billion, in the morning, or sometimes like depending on the time zone, that could be in the afternoon. So those might have a very large impacts on the market as well.
Yeah, cool. That would be interesting. Yep. Good
so
point.
I'll on that. And then the last bit was, can you make money with this?
Not with the statistical mouse, not yet.
if you can predict the pay and the initial margin amounts, like how much liquidity is going to get sucked, and then
yeah.
You should be able to. All right, thank you.
Okay, thanks.
Thank you so much, Kimmo. And it was a nice question if Christoph could make money with it. But what are your future research plans, Christoph? Maybe you can share with us. So what are you thinking about now?
At the moment, I only think about a way to determine the causality effect of the initial margins themselves by CCPs. And then it will take, I don't know, another 2 or 3 months to finish this paper. And there are another 2 papers that I should finally finish because I was lacking time in the last few months. And these are my plans at the moment. So no interesting topic that I can up with now. No.
So let's get back to it 4 or 3 months later, and we are looking forward to hear your next future plans.
Okay.
I think that we have a question from Firdaus Malik. Malik, do you want to hear? Do you want to say your question aloud, or do you want me to read it for you? Yeah, yes, you can talk. We can hear you.
Hello. Yes, am I audible?
Yes, we can hear you.
Hello.
Hello.
Yes, actually, I have joined the. Yeah. Yes, am I audible, sir? Hello, am I audible?
Yes, 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 we can hear you. Yes. So your question was, can
Yeah, actually, I have joined the discussion.
Okay.
Yeah, I have joined the discussion at at the very end. So my query is against this dummy variable.
Okay.
So as I am not well aware of the study I have.
Okay.
So I need, what is the, why you have chosen this time as a dummy variable, and how you have decided this reference category?
Yeah.
Thank you.
So the idea simply was there is a new kind of rule that affects initial margin requirements. And I expected, and I was not alone with that, that as soon as these uncleared margin rules are introduced, that many people will shift or move into cleared products. And therefore, the volume of initial margin requirements in CCPs goes up, although there's no change in risk whatsoever. It's just because of new regulations. I can show you how I constructed these variables. It's basically just indicator variables on September 2017, 18, 19. A new phase starts, and that's simply an indicator which is always 0. And in September 2018, it's run, and it goes on with 1. And other variables, let me check how I can share my screen. Here we are. So there is work from Richard Haynes from the CFTC. And here you see the number of entities and the number of notional amount that is actually covered by the introduction of these new rules. And based on these numbers, I've played around and introduced a few dummy variables. And so this is a variable depending on just on the average ANA per entity, etc., etc. So actually quite simple, and it works. And it's of course, if it works, it's a causal effect. There's no feedback from financial risks to these variables. That's not possible. And yeah, that's basically it. Here is the paper by Richard Haynes, if you're interested. Just a technical report from the CFTC, and buried in this technical report, you find all the relevant information. Yeah, that's it. And now I'm looking for other regulatory changes that might really affect the size of the initial margins required by CCPs. Again, independent of a change in financial risk. That's basically the whole paper. That's the whole paper, more or less.
Thank you, Christoph. And also, Kimo sent you a message that you can find the page.
Ah, yeah, lovely. Thank you.
Thank you, sir.
And thank you, Firdaus, that your question, I think that was very useful, that you asked what was a dummy variable. Okay, and if we have no more questions to Christoph, let us thank to his super nice, super interesting presentation.
No, I thank you.
And we are looking forward to your next session with LPFMI community. And finally, the last 2 presenters of this session are from Indonesia, and they are non-academics. So I think that is a huge challenge to them. And it is also a great chance for us to listen to their results. So Please, Alwin and Azarayan, the floor is yours, and please introduce yourselves because I was not able to find many information about you. Please tell something about your background. We are looking forward to your presentation.
Thank you, Adam. Can you see, sorry, going back. Okay. Thank you, Adam, for the opportunity. First of all, it's an honor for us to present our work here at the YSI plenary. Our work is about the regulatory framework for technology-enabled banking services in Indonesia. And I'm Alwin. I co-wrote this paper with Elsa, my colleague. We graduated from the University of Indonesia, both of us from the Faculty of Economics, and we now work at the Indonesia Financial Services Authority, or DOJK, but please do note that this paper is our personal view and it does not represent the official view of DOJK. I will first start the presentation, then Elsa will jump in afterwards. I will start by discussing the overview of Indonesia and its digital economy. Well, I've seen earlier that Kimo, he has like a gift from Bank Indonesia, so I assume that he's very familiar with Indonesia's digital economy and digital financial services landscape. But I will go through quickly on this matter. First of all, Indonesia, we are the 4th largest country in the world by population. 20% of our population, it belongs to the middle class. And we have a very thriving digital economy. If you see here, 130 billion is the size of our internet or our digital economy is expected to be $130 billion in 2025, up from 40 billion in 2019. And the average growth of our digital economy was the highest in Southeast Asia, or in the ASEAN 6. It was from 2015 to 2019. And for our digital financial sector, over 200 companies, Fintech companies have been registered with the OJK and the Central Bank, Bank Indonesia, respectively. And the COVID-19 pandemic, it has accelerated the use of digital financial services. We'll go on this matter later. And OJK recently has launched the Digital Finance Innovation Roadmap and Action Plan for the next 4 years. You can see in our website. There's an English version also, but despite this, our financial sector still has a lot of room for growth. We see, because of these 4 factors in the right side of our slide, you can see that, for example, there is still a lot of customers in Indonesia, especially with lower educational background. They still prefer using conventional financial services compared to digital ones. And only few use internet banking, and there's still a financing gap for SMEs. Next, I'll just go through this very quickly. It's about the landscape of our financial sector. Probably the most interesting indicator here is on the upper right side, where the informatics and communication sector, it was the top source of growth in our economy in the first quarter of this year. Also, we've launched our Literacy and Inclusion Index last year in 2019. It still has a lot of room for growth. As you can see, the literacy rate is only 38%. So again, there's a lot of room for growth, and Indonesia still has room for growth also for internet users. It grew 17% from January 2019 to January this year. Next. This is about, again, just very briefly, the impact of COVID-19 to the digital transformation in our banking sector. It has changed how consumers consume and use financial services. I think that this also happens in a global basis also, as you can see probably on the graph or the picture in the left-hand side of the presentation. Like after COVID-19, it's expected to more than around 3/5 of banking customers, they continue to use online banking services. And especially for in Indonesia's case, you can see that Savings, it grew 76% during the pandemic, and for example, top up of e-wallets, it grew to 52%. Next. So after seeing like the trigger factors, our question is, why is a regulatory framework for technology-enabled banking services necessary? Well, we see two things. The first thing is to balance between innovation and adherence to prudential principles. We think that innovation, it should not be hindered by regulation, but also innovation, it needs to be kept in check so that it doesn't create additional risk to the financial system and does not jeopardize financial stability. We also see that new technologies, they will have an impact on the banking sector, who have been long dominating the financial sector assets and activities. So that's why we need to regulate them, because it will change like the business model of banks. And we see there are three potential approaches of regulation of technology-enabled like banking services. Well, in our research, we only focus on the first aspect, as it relates really to our current scope of work. And we look at issues discussed by international standard setting bodies, the experience of others, and also relevant regulations in our country. Next, this is like a literature review of the implications on the banking sector. We looked at papers published by the BCBS and the FSB. The BCBS's paper is personally one of my favorite papers to look at on the technology implications of the new digital technologies. Well, basically, we can share to you that there are 5 positive or negative implications that are identified of new technologies to banks. And financial stability could be at risk if new players, if they gain access to the financial system. It will exploit regulatory loopholes, and because it might induce risk-taking behavior by existing banks to compete. The second aspect is that it will enhance financial services through lowering the barriers for new entrants, and by offering lower costs. We cite an example for cloud computing here. It's cheaper to use the cloud than legacy IT systems. And also it will support more personalized financial services. The third aspect is on regulation. We think that regulation should consist of risk management framework on the use of IT, regulatory sandboxes, as well as digital banking and AML CTF. And also data privacy law. This is very important. In Indonesia, it's still a draft right now. Because financial institutions, they are usually the largest users of personal data, and it could be for the better or for the worse. Well, that's my segment of the presentation. From this point onwards, Elsa will continue the presentation. Elsa, please.
Thank you, Alwin. Could you see my voice? Could you hear my voice?
Yes, we can hear you clearly.
Thank you. Okay, let me continue the presentation. Financial Stability Board states that currently any assessment of the financial stability implication of fintech is challenging, given the limited availability of official and privately disclosed data. From FSB papers, we see that there are 2 financial risks, micro-financial risk and micro-financial risk. So in micro-financial risk, there are 2 risks. Financial risk and operational risk. And the operational risk one is related to the bank prudential aspects. From the other aspect is macro financial stability risk that occurs when certain innovation that has potential to introduce macro financial stability that could amplify shocks to the financial system, and that also FSB argue that there is no evidence that fintech has an impact on at present financial stability. So we will just solve the FSB argument. And the next, it's still lack of evidence that from Indonesia, which gives empirical result between fintech and financial stability. We just find there is a study from Darudin that fintech startup in Indonesia does not reduce bank stability, bank profitability, and bank lending growth, which indicates that fintech does not disrupt bank performance. Next slide, please. Currently, there are two authorities regulating fintech in Indonesia. Bank Indonesia as central bank regulates fintech relating to payments. Second one, Indonesia Financial Service Authority or OJK regulates fintech companies that provide financial services such as digital banking, peer-to-peer lending, crowdfunding, insurtech, investment, and market aggregators. There is a legal umbrella for fintech companies offering innovative to play in regulatory sandboxing. It's designed as a principle-based regulation for fintech industry and aimed at creating responsible digital finance innovation. Next slide, please. OJK issued a regulatory paper on regulatory offered in March 2020 on the consolidation of commercial banks. This regulation has seen as an effort to strengthen the structure, resilience, and competitiveness of the banking industry, which can eventually support national economic growth and resilience. Next slide. OJK also issued a regulation concerning in the implementation of digital services by commercial banks. It regulates the use of electronic banking services developed by optimizing the use of customer data in order to serve customers more quickly, easily, and according to their needs. We must emphasize product innovation, cooperation with partners, and digital processes to ensure better services for a consumer and effective risk management. Next slide. Bank Indonesia as an Indonesian central bank also launched the 2025 Indonesia Payment System Blueprint as a guidance to accelerate digital transformation in payment system. And from my last slide, please, next. As new entrants, fintech companies must obtain trust to compete with long-established players and regulators. They must ensure that innovative financial services are well backed with sound risk management practices. The focus now is on the regulatory framework to support these situations. On the prudential or risk management aspect of the business, Indonesia already has a regulation that supports digital financial services. Other thing that need to do is to establish policies such as data protection law and national security roadmap that is on progress to be issued. That is all our presentation today. Thank you for the opportunity. Back to Adam. Thank you.
Thank you, Elsa. Maybe you can say some words about you because you have not introduced yourself, if I'm not mistaken.
Okay. Hi all, my name is Elsa Ramdhani. I'm Alwin's college. I'm also working in Indonesia Financial Stability, Financial Service Authority, same with Alwin, my college. And yeah, our paper is not represent my employer's view. Thank you.
Thank you so much. Kimo, could you please comment this presentation? Thanks.
Yeah, maybe just very quickly, I think it was very interesting. I think a lot of regulators are struggling to understand the fintech space. So we've had also conversations with World Bank, who is helping some other countries to understand the entrance to the market. Who are they? What are they doing? The whole ecosystem. I think that's part of the work that you're also trying to do, and I think but those sandpits and other sort of engagements with the industry are largely meant for that purpose. It's also a network problem, actually, because the way that we are looking at it is to help some of these authorities is to start building networks around related party networks. So look at, start from a few companies, look at the investors, look at the beneficial owners, look at the directors, look at what other companies they're directors of, what other investments they've made. And by doing this type of like a cascading analysis, you start to understand that the ecosystem better, and find a lot of new questions that you want to start asking, what are these doing? I haven't heard of this before. In order to just do like a knowledge exploration through this this type of network, like a bottom-up network analysis. Yeah, maybe that was the what I wanted to add here.
Thank you, Kimmo. I also have a question or maybe a comment, because I'm also researching the fintech ecosystem, including the central banks, and I made some interviews all over the world. And I've never went to Indonesia, but I would be really interested about the attitude towards the fintechs from the central bank. I mean the financial regulatory institution there. So they are positive. They are encouraging the fintech companies, or they see more the threats and risks also attached to the fintech startups.
Hi, Adam. I think there was a question in the chat box from Firdaus Malik.
Ah, sorry. Okay, I didn't see it.
Yeah. Can we answer the question?
Sure, please.
Well, I think Elsa can add to my statement later on, but he asked about what's the digital situation in Indonesia prior to the pandemic. Well, we have been quite developing our digital banking sector. You mentioned about fintech. Yes, we've had regulations in place before the pandemic. For example, the regulation on fintech in Indonesia was for OJK was released in 2016. For banks, we don't have a regulation or framework yet right now on like the purely digital or virtual bank, probably such as like Monzo. But what we do have in Indonesia prior to the pandemic was existing incumbent banks. They would create like a separate offering or separate product that offered only like a digital only savings account. So that was like the trend prior to the pandemic, and most of their operations have also been digitalized, but we still have like some gaps, probably not gaps, but we still we're still developing like our regulations for the full digitalization. Like for example, cloud computing. Well, we don't have like a specific guidance yet on that, but banks are using it based on existing regulations on risk management on the use of IT. But the digitalization process was ongoing prior to the pandemic, and it showed during the pandemic the resiliency of banks to continue operating and identifying their critical functions during this tough time. I think that's it for me.
Okay, I will add Alwin answers. So thanks to the question for those Malik. Absolutely, banks in Indonesia have been considering about the IT development, especially in infrastructure. Since 2017, they are aware for the digitalization, and the COVID absolutely accelerates the digital transformation in banking system in Indonesia. So in my personal opinion, there are two important aspects that government outside the central bank and OJK itself that have been established is a national data protection law and then the cyber security roadmap. So those two enablers are important to support the banking digitalization in Indonesia. That's all.
Thank you so much. We are close to running out of the time, and let me just ask any closing remark from Kimmo, from your side, or the other participants of the panel.
Just 15 seconds more. So I think in a lot of countries, the COVID has really accelerated this digital world, because a lot of people didn't have means to operate in the digital world before. And that's actually also, we haven't mentioned it yet here, but the central bank digital currencies, I think it's also something that the central banks are starting to seriously think, especially in emerging countries, in smaller countries where cash is very expensive to operate, to start offering digital means of payment. So I think that will also come as part of the ecosystem very soon in many places. But I think the drivers for that are more financial inclusion and cost of cash rather than others. So we probably won't see them in the UK very soon.
Okay, so thank you for that closing remark, and I'm so happy that I could be here with you, and I hope that this discussion will be followed in the future. And I cannot be more than agree with you, Kimo, that financial inclusion is a hot and sexy topic, and CBDC is also gaining a relevance topic, and I'm sure that we are going to discuss that in the future, and we would be very happy that you could. We would be really delighted that you could be there with us in the future communication. And if there is any comment from your side, I sent a message that please send your presentation. I already received Christoph's, so I'm going to share Christoph's to your email addresses. And please, if you want, please share yours also, so we could check again and read the details. And now I stop the recordings.